This week's market action revealed something fascinating about human nature. While the S&P 500 hit new all-time highs on Monday, it reversed within 48 hours. Meanwhile, over 300 individual stocks actually rose as the Magnificent Seven declined. The crowd saw sector rotation, but missed the deeper pattern unfolding beneath the surface. Here's what really happened. Investors demonstrated textbook recency bias, aggressively rotating out of technology after a year of dominance while chasing small-cap momentum that had already extended 9 sessions. This reflects loss aversion in action. Participants feared missing the value rotation more than abandoning proven winners. The Russell 2000's 9-session streak matched a 34-year record, yet money kept flowing in. Classic herd behavior disguised as strategic positioning. The DOJ investigation into Powell triggered what I call authority anxiety, a primal response to institutional instability. Gold surged past $5,000 not as rational hedging but as emotional insurance against perceived chaos. Energy stocks hit new highs while semiconductors shed 4 to 5%, exposing momentum-chasing reflexes dressed up as sector analysis. Now let's examine how the system actually processed this information. The indices printed technical exhaustion signals as the S&P reversed from all-time highs within 2 days, a pattern consistent with distribution rather than consolidation. Sector flows showed violent rotation with the widest single-week dispersion between cyclical and growth factors since late 2022. Bond markets absorbed the Powell news rationally, with yields rising 7 basis points to 4.23%. Credit markets correctly priced an independence risk premium into duration, while equity participants ignored the signal. The 10-year, 2-year spread remained inverted, maintaining recession signal integrity despite surface equity resilience. Commodities revealed the system's true condition. WTI crude rallied 6% on geopolitical supply concerns, while gasoline prices fell 3.4% year over year. This exposed refining margin compression and demand weakness beneath headline energy strength. Gold's breakout occurred alongside VIX, remaining subdued at 15. Institutional hedging through physical assets rather than derivatives. Earnings season opened with financial sector beats on trading revenue, but investment banking misses. This confirms that volatility creates opportunity while deal activity requires confidence, two conditions that rarely coexist. The CPI print at 2.7% headline kept Fed pause expectations intact, with June as the earliest realistic cut. Volume patterns showed distribution days accumulating as breadth diverged from price. The Magnificent Seven's collective decline, despite 300 S&P components rising, indicated narrow leadership exhaustion and capital redistribution into lower quality names, a classic late-cycle distribution pattern masked by positive advanced decline ratios. The Stoic approach recognizes these patterns as exploitable inefficiencies. Markets operate as information processing mechanisms indifferent to participant emotion. This week's rotation represents mechanical rebalancing of capital toward perceived relative value after extended divergence, neither wisdom nor folly. Energy's breakout occurred on legitimate supply disruption catalysts from Venezuela and Iran developments, making the move structurally valid until supply conditions normalize. The Russell 2000's historic streak will terminate not because streaks must end, but because fundamental conditions supporting small-cap outperformance will shift or exhaust available capital. Gold's advance reflects central bank accumulation and currency debasement reality, monetary insurance rather than speculation. The Magnificent Seven's decline after multi-year outperformance represents natural profit-taking and valuation normalization, not paradigm shift. Participants who interpret sector rotation as predictive signal rather than reactive adjustment will misallocate capital. The divergence between index weakness and breadth strength indicates capital redistribution rather than risk-off, a process that can persist for extended periods without resolution. Geopolitical tariff announcements create volatility but rarely alter structural trends. Markets that rallied despite threats correctly assessed implementation probability versus rhetoric. The technical exhaustion signals at all-time highs represent normal consolidation after vertical advances, not reversal confirmation. The system rewards preparation and punishes prediction. Participants who demand certainty about direction will find none. Those who position for multiple outcomes while managing exposure to each will compound capital regardless of resolution. History shows humans consistently mistake reactive price movements for predictive signals. The crowd reacts emotionally to headlines while disciplined capital allocators focus on structural conditions and probability-weighted outcomes. Second-level thinking means recognizing that obvious sector rotation stories often mask deeper distribution patterns. This is exploitable because emotional participants chase momentum while systematic approaches harvest the volatility they create. If you value systematic thinking over market noise, subscribe for frameworks that exploit predictable human behavior. Download the complete Stoic exploiter methodology in the description for those who choose discipline over emotion in their capital allocation decisions.